Let's say you're in a situation where your money earns you more profits, all without having to lift a finger. Wouldn't that be amazing? Well, with SCHD, that's exactly what some investors are doing, getting constant revenues without having to worry about the fluctuations each and every day in the stock market. Well, it's actually more than an EFT. It's a way to grow your wealth over time, with reliable companies paying you just to hold on. And the thing is, you don't need to be wealthy to start. This strategy clearly argues that it's possible to turn even a small amount of money into something considerably larger. So the real question is, will you take those first steps toward creating that future today? Or will you forever sit and ask, what if, or I should have? Well, let's get started and discover how SCHD can benefit you. Alright, so let's say you're ready to dive into investing, but the idea of picking individual stocks feels overwhelming. You hear terms like dividends, equity, and ETFs, and suddenly it feels like you need a finance degree just to get started. That's exactly where SCHD, the Schwab US Dividend Equity ETF, steps in to simplify things. It meticulously tracks the Dow Jones US Dividend 100 Index, including 100 US companies with proven dividend profiles and solid financial fundamentals. Think of it as a ready-made basket of some of the most reliable US companies, all bundled together for you. These companies are pros when it comes to paying steady dividends. Basically, they share a slice of their profits with you just for being an investor. With SCHD, you're not betting on just one or two companies. Instead, your money spreads across many well-established businesses, which helps lower the risk. It's like having a financial safety net that works quietly in the background. And the coolest thing about SCHD? It doesn't break the bank to own it. The expense ratio is about 0.06%. So, if you invest $1,000, then at its most, you'll be paying 60 cents in fees in the year. And that is much less than the price of a cup of coffee. Also, a substantial portion of the total assets of SCHD can be attributed to larger companies such as PepsiCo, Cisco, Verizon, and Broadcom. They are the companies that have been existing in the market and have survived not only market fluctuation, but also have never ceased to provide their shareholders with profits. Getting started with SCHD is easier than you might think. You don't have to start with a capital of several $1,000s. Most of the platforms today give you the opportunity to buy any stock you want in fractions, which means that even $10 can be enough. The one thing that makes it work is consistency. Well, that is when dollar cost averaging comes to the rescue. It doesn't matter if a market is up or down. You will invest the same amount at the same time intervals, let's say monthly or weekly. For some months, you might take more shares when prices are low, and for others, you might take fewer shares when prices are high. In the long run, DCA removes the hype out of investing and helps investors to remain focused and on track. Now that you know how easy it is to get started with SCHD, let's explore how it stacks up against a popular contender, because choosing the right ETF is all about aligning with your goals. Now, SCHD, Schwab US Dividend Equity ETF, and S&P 500 ETF, SPY, are considered to invest, but they're both designed for different goals. Consider the S&P 500 ETF to be the most comprehensive look at the US equity market. It tracks the biggest firms in several sectors, from technology to retail. Whereas SCHD focuses on businesses that have maintained a record of highly dependable, sustainable dividends. Nevertheless, the two ETFs have the potential to help you accumulate more riches, although they suit a certain style of investor or hold certain priorities more than the other, steady income or aggressive growth. In terms of performance, SCHD has shown solid returns, especially in markets where value stocks shine. Consumer goods and financial companies, which make up a large part of SCHD, have driven much of its recent success. Actually, over the past 3 months, SCHD returned around 9%. This just proves the ability it has to succeed in favorable market conditions. However, the S&P 500 also has its own strengths. It reflects the overall performance of the U.S. economy, including fast-growing industries like tech. In bull markets, particularly when the tech sector is booming, the S&P 500 offers higher total returns for the long term and outperforms the SCHD. Then there's the question of dividends. SCHD's main draw is its 3.47% dividend yield, paired with a 5-year dividend growth rate of 12%. This makes it an excellent option for investors who want consistent income or plan to reinvest those dividends for compound growth. By contrast, the S&P 500 offers a lower yield, typically between 1.5% to 1.7%, since it focuses more on capital growth than regular payouts. If your goal is to maximize cash flow, SCHD might be the better fit. But if you prefer betting on market-wide growth, the S&P 500 could be more appealing. When it comes to risk, SCHD tends to be a bit more stable. With volatility at 2.53%, it's slightly less sensitive to market swings compared to the S&P 500's 2.91%. The S&P 500's broader exposure across sectors means it can rise sharply, but it can also drop faster during downturns, especially when high-growth sectors like tech take a hit. SCHD's more conservative nature makes it a solid pick for investors who prefer stability with fewer roller coaster moments. Understanding how SCHD compares to the S&P 500 is crucial, but the conversation doesn't end there. Some lingering myths about SCHD might still be holding you back. Let's clear those up. One common misconception is that SCHD only focuses on income, not growth. Sure, SCHD is known for its solid 3.47% dividend yield, but it's not just about collecting payouts. In fact, SCHD has a strong dividend growth rate of 12% per year. And here's the thing, over the last 12 months, it delivered a 25.58% total return, a mix of dividend income and price growth. Another myth is that SCHD can't keep up with the S&P 500 in total returns. While the S&P 500 shines during tech-driven bull markets, SCHD has held its ground and even outperformed in certain periods. That's because its strategy of reinvesting dividends can boost returns significantly over time. So, while SCHD may not soar with tech stocks, it quietly builds wealth through steady growth and payouts. By now, you can see that SCHD offers more than just dividends. But if you really want to take your investing game to the next level, you'll need to know what's under the hood: tax strategies, sector focus, and the long-term plan. Interestingly, SCHD's selection of stocks is particularly designed to invest in sectors with value stocks that pay dividends. You should know that it focuses a lot on defensive sectors, which is different from the S&P 500, for instance, which heavily includes the technology sector. SCHD is highly exposed to financials, consumer staples, industrials, and the healthcare sector. Financials play a big role, benefiting from stable dividend payouts. Consumer staples like food and household goods companies shine during economic downturns, giving the fund steady performance. Industrials fit SCHD's strategy perfectly, as these companies often generate consistent cash flow. Healthcare adds another layer of defensiveness, with steady income even when markets get shaky. SCHD deliberately keeps its technology exposure low, which helps reduce volatility, making it an attractive choice for those seeking stability across different market conditions. However, it would be impolite not to say anything about taxes, because after all, smart investing is also about keeping more of what you earn. Notably, one of SCHD's standout features is its tax efficiency. What does this mean? Many of its dividends are considered to be qualified dividends, meaning they're taxed at the lower capital gains rate instead of the higher ordinary income tax rate. This can be a lifesaver. especially when you're trying to reduce your tax liability in any given year. Plus, there are additional strategies you can leverage. For example, tax loss harvesting lets you sell SCHD at a loss during dips to offset other capital gains. But what about the long-term investing strategy? Well, due to its versatility, it's suitable for any type of investing approach. SCHD ensures investors obtain steady dividend income without compromising on the potential for long-term growth, for those investors who are interested in income and regular cash flow. So, with all that we've talked about, what do you think about this ETF? Will you add it to your portfolio? If you will, then why? Please let us know in the comments. In the meantime, you can leave a like, subscribe, and turn on the notification bell for more amazing videos like this one.